afternoon and welcome back to Money Control live stream. You're watching the closing bell. I'm Santosh Nair.
And I'm Yatin Mota.
Well, Yatin, feels nice to be back here once again locking horns with you.
Yeah, and whenever there is a start of the bear market, you tend to generally appear on Money Control shows. Is it?
Precisely.
2 days of bear market and Santosh is here with us with a red bear full in action seen in trade today.
Well, and with that, let's take a quick look at how the markets fare today. The BSE, Sensex and the NSE Nifty falling for the second day in a row, second day of fairly steep losses, I would say, 0.5% down. You're not seeing the market fall 0.5% for 2 days in a row for quite some time now, Yatin. Mid cap and small cap shares, however, fared slightly better. They were under pressure, but not to the extent as much as some of the frontline shares were under. In sectoral trends, banking stocks were among the outperformers, whereas auto, IT, FMCG and metal shares were under pressure. In specific stock moves, IEX was the biggest loser today. Yatin will be talking about it more in detail in a few minutes from now, but that's broadly what the market is like at this point. Yatin, the weakness comes as a surprise considering that global markets are pretty firm at this point in time and US in fact is now in bull territory.
Yeah, US, you are correct that Nasdaq select stocks are moving in the US markets. Europe is also fairly stable, but if you talk about the domestic markets, I think we are at all-time highs and probably in the quest to get near to the all-time high, there is some resistance which is coming in the market. But a 50-60 point correction yesterday and today doesn't really matter in an index which is hovering around 18,800, 18,700. Yes, last 2 days have been quite weak, especially for the mid caps which have been flying in trade. Mid cap indices touched all time high. Typically the market behavior when we trend to approach the all time highs. Let's hope what the RBI said in terms of inflation moderating. A lot of economists saying that from Q4 onwards we could see some rate cuts that will boost the economy overall. Obviously there is election year, plus the RBI not really talking about rate cuts in yesterday's policy meet, and probably that was a bit disappointing given the market was in a very bull phase.
Well, Yatin, no rate cuts is also not such a bad thing after all,
yes,
considering that in fact many economies across the globe are in fact raising rates even as we speak at this point. Yatin, what do you make about the drop in equity inflows for the month of May? Of course, the SIP book still continues to be at a record high, but there seems to be some pressure as far as the equity inflows.
Equity inflows are, yes, the lump sum investments are slightly weak, and Santo, usually what happens is March में investment हो जाता है, April में थोड़ा बहुत investment हो जाता है. May generally is a slow month. That is the reason why a lot of people say that sell in May and go away.
Exactly. I think mutual fund investors seem to have followed that principle.
And March, April is generally the month wherein you begin your investments on a lump sum basis, and May generally is lean. But yes, flows are moderate, but FIs are still buyers.
Well, and with that, let's take a quick look at some of the stocks that caught our attention in trade this afternoon, beginning with MCX. Now, the stock once again managing, not just holding ground in a weak market, but it's also been inching higher. A steady performance there from MCX, and according to market chatter, a lot of HNIs seem to be accumulating the stock, although institutional investors don't seem to be very upbeat on MCX at this point in time. Now, MCX had been under pressure for some time. In fact, for the early part of this year, there were concerns about pressure on margin, and that was because of the fact that MCX was migrating to a new software platform developed by TCS, but that got delayed, as a result of which MCX had to extend its existing arrangement with 63 Moons, and the impact of that was seen in the fourth quarter when there was a sharp rise in operating costs. The company barely broke even at the operating level, but now the general view, at least among a section of the HNIs, is that probably the worst is over, and once MCX migrates to the new platform developed by TCS, probably you could see a sharp reduction in operating costs. At least that is the bet. However, Morgan Stanley is bearish on the stock. It retained its underperform rating on MCX after its fourth quarter earnings. It has a target price of 1125 rupees, and one of the reasons that it has cited is that the slow earnings progression, and because of that premium valuations are really not justified in the case of MCX. Also, if you look at it, back in for the year FY 2012, MCX had reported sales of 545 crores and the operating profit margin at that time was about 65%. And now in FY23, sales are pretty much around the same level. Operating profit margin has dropped to about 28%. It was 28% for this year, but broadly it has been in the 45 to 50% range for a while now. So this clearly shows that the company has not been able to grow its revenues in a big way, which will be the key for the stock actually to get re-rated.
Absolutely, and MCX is one stock which is on the radar. Once I think the software issue with 63 Moons and TCS gets dodged, I think the company will be back on its growth track. Especially all of these one-time expenses, I think Santosh should stop for the company, leading to higher profitability in the coming financial years. But keeping it with the exchanges, one of the exchanges stocks which tanked 20% in the last 2 days is IEX. Now Antique today downgraded the stock of IEX. They have a sell rating on this one with a target of 105. Now why did IEX fall in trade for the last 2 trading sessions, 10% straight lower circuit today as well? Because the power ministry recommended to the CRC to pool the clearing prices of power which is traded on exchanges. What this really means is that if IEX has several contracts, a lot of other exchanges have many contracts in which price discovery is different, then there is a problem. So the government really wants a super exchange or a body which is above these exchanges to determine a single power price, which the market believes that once single window clearing of power prices will happen, it can reduce the power volumes on stock exchanges and electricity exchanges significantly. Now, if you look at IEX, they have more than 200 price discoveries happening at different points in time. There are short-term contracts, there are long-term contracts, there are medium-term contracts. What the government really wants to do is make price discovery much easier, much leaner, and it has to be guarded by a exchange which is above these exchanges or a body which is above these exchanges. And brokerages like Antique believe that this could be leading to significant market share loss and volume loss for IEX. There is a possibility of a coupling operator which can net the power flow in each zone. Number one. Number two, incentives by competitor exchanges like HPX and Power Exchange of India can eat into the volume growth, because once government homogenizes the entire power price discovery, other exchanges like PXIL and HPX could gain, which could be negative for IEX, and hence the entire discussion paper which is still pending to be issued by CRC. Ahead of that, we have seen some panic in the stock price.
Yatin, what do you make of this? Is the market overreacting at this point in time? Already valuations seem to have moderated from their really dizzying highs which we had seen sometime in December 2021 when the stock was quoting close to about 300 rupees. Now in this case, by the time the discussion paper comes out and the rule is finally implemented, there could still be time. So you think there is some kind of a trading window there possibly?
Yeah. So if you listen to the management of IEX, what it is told to CMZ TV18, that first stage is that CRC floats a consultation paper that will give more clarity, and after the consultation paper is floated, they will give their suggestions to the regulator, and then there will be a decision which will be taken. The entire process is long drawn. Number one, there are several unknowns, and IEX believes that the market interpretation, which is the analyst or the market interpretation, is quite wrong with respect to the power ministry recommendations. IEX believes that the entire system would get strengthened and there could be no volume leakages which they foresee. But I think the language in which power ministry has recommended certain steps to be taken by CRC itself have created some bit of selling pressure in the stock of IEX. Any which ways, the stock has been witnessing domestic mutual fund and FI selling, which has accelerated in the past 2 days. But yes, Santo, management does believe that there is still more time and more clarity which is still awaited in this matter.
Well, and with that, we move on to a third stock on our watch list this afternoon, and that is Interglobe Aviation. The stock has managed to make a good comeback since touching a low of close to about 1850 rupees in March, and from there it's risen close to about 34%. Now, the March quarter numbers were not all that great, but probably the market is looking past it. Seasonally, the June quarter numbers are very strong. That's also because that's the vacation season, that's when most people travel. Besides that, the outlook on crude prices, that has also softened over the last couple of months. Crude prices have been fairly steady, barring the occasional spike, barring the brief spike, they have been largely within a narrow band and are expected to stay that way for some more time. But the biggest positive for Interglobe Aviation, Yatin, was mainly the problems that both its competitors Go First as well as SpiceJet, and crazy airfare seen on certain sectors during the month of May in particular, after Go First decided to shut down its operations. So clearly these two factors, one is that benign outlook on crude oil prices. Crude fuel expenses are about 50% of airlines operating expenses, so there's some relief there. Plus, May and June are turning out to be a bumper month for Indigo because of the problems that rival. But there is still one factor, Yatin, that is the Gangwal family, one of the promoters. They have been steadily paring their stake in the company. They still hold close to about 28%, and chances are that they will continue to sell in the coming days, months as well. But that is something that the market does not seem to be focusing on at this point in time. Clearly they want to look at the positives, which is that the relief on crude oil front and also the strong airfares at this point.
Yeah, I think and Santo, crude prices also help, and I think there has been a duopoly between the Tata Group's airlines, which is Air India and Vistara, and now Interglobe Aviation, because if you look at SpiceJet, they also have been off lately cancelling a lot of their operations and flights. Indigo, as you mentioned, Go Air, they have also been to a rough patch. Jet Airways has not been able to revive its operations. So in absence of competition, yes, there has been a lot of importance which is given by the markets. One is the gain in market share, and two, the operating leverage and the margins which they have got in this particular summer vacation season. Well, that was about Interglobe Aviation, and the last stock on our radar today is Avenue Supermarts. Remember, the stock has been witnessing some selling pressure. Quarterly results were also not that great, but today Motilal Oswal Financial Services has upgraded the stock of Avenue Supermarts, which is DMart. They have upgraded it to a buy with a target of 4,200. Motilal Oswal believes that they are all set to revive their earnings growth. Also, they do expect the competitive position of DMart to remain intact despite the pressures coming in from the retailers, especially from the online side, when we have seen quick retail picking up pace because of higher discounting as well as quick deliveries. But that apart, DMart itself has tried to build their own online network which is quite efficient in terms of delivery time, turnaround time, and they have not been burning large amounts of cash there, which is a silver lining according to Motilal Oswal.
The last part which you mentioned, that they are not burning cash, I think that is pretty important, and it's quite commendable the way DMart has in fact managed to stand up to competition in what is a very fiercely competitive field. But at the same time, Yatin, valuations still are a little.
Yeah, it has always remained that.
It's trailing what, 100 times trailing 12-month. It's quoting at 100 times trailing 12-month earning. That's been slightly on the higher side, and I think that's something which has already been priced in, because you have not seen the stock really move up after hitting a high of about 4,600 rupees sometime in 2021. Since then, it's never gone back to those highs. So, but at the same time, I think valuations still are a little expensive, I would say, Yatin.
Absolutely, there is no doubt that Avenue Supermarts since the listing and the run up has always been an expensive stock. But yes, they have been able to create shareholders value. Obviously, the stock has been lean for the last 6-12 months in terms of share returns, but let's see whether or not this Motilal Oswal upgrades works for the company.
And last stock on my watch list is Dr. Reddy's. The stock had seen a sharp sell-off after its fourth quarter numbers that turned out to be below what the market was expecting. But since then, the stocks appears to be making a slow and steady comeback. It's gained close to about 6-7% from that level. Nomura is bullish on Dr. Reddy. It has a buy rating on the stock. It has maintained that, and it has a price target of 5,161 rupees now. According to Nomura, the India formulation business is going to be the key focus market for Dr. Reddy's, and in fact, Dr. Reddy's has been attempting to differentiate through innovation. As far as the US generics market goes, that's likely to remain competitive, but at the same time there are plenty of short term opportunities in the current market, and Dr. Reddy's focus is on launching products where the competition is less. Yatin?
So, Dr. Reddy is something we'll watch out for because the entire pharma pack has been plagued by the US FDA inspections which have been there recently. Obviously, companies like Cipla, Cadila, Sun Pharma, all of them are facing the heat by the US regulator. Dr. Reddy's also has their own problems, but yes, they have been growing well when it comes to US markets as well as the domestic markets.
Well, and with that, it's a wrap on this edition of Closing Bell. Thank you for watching.
जुड़ने के लिए बहुत बहुत धन्यवाद.
And we wish you all a happy